For traders, staying informed about key economic data is crucial, as these indicators can significantly impact financial markets. Here's a rundown of some of the most important economic data points and how they can influence trading decisions.
1. Gross domestic product, or GDP. GDP measures the total value of all goods and services produced in a country over a specific period. It's a broad indicator of economic health. Now, let's talk about its impact on markets. Positive GDP growth generally signals a strong economy, which can lead to higher corporate earnings and potentially higher stock prices. On the other hand, negative GDP growth may indicate economic contraction, leading to lower stock prices and potential increases in bond prices as investors seek safer assets.
2. Employment data, non-farm payrolls, or NFP, reports the number of jobs added or lost in the economy, excluding farms, government, and a few other job sectors. The unemployment rate represents the percentage of the labour force that is unemployed and actively seeking work. When it comes to the impact on markets, strong employment data indicates a healthy economy, potentially leading to higher interest rates as the central bank may raise rates to prevent overheating. Conversely, weak employment data can signal economic trouble, potentially leading to lower interest rates and higher bond prices as investors seek safety.
3. Consumer Price Index, or CPI, and Producer Price Index, or PPI. CPI measures changes in the price level of a basket of consumer goods and services. It's a primary indicator of inflation. PPI measures changes in the price level from the perspective of producers, providing insights into inflation at the wholesale level. When it comes to the impact on markets, rising inflation, as indicated by the CPI, can lead to higher interest rates as central banks may tighten monetary policy to control inflation, which can impact stock and bond markets. On the flip side, falling inflation might prompt central banks to lower interest rates to stimulate the economy, potentially boosting stock prices.
Interest rates. Central banks, like the Federal Reserve in the United States, set benchmark interest rates that influence borrowing costs throughout the economy. Higher interest rates can lead to a stronger currency and lower stock prices as borrowing costs increase. Lower interest rates can stimulate economic growth and lead to higher stock prices, but may also weaken the currency.
Retail sales. This measures the total receipts of retail stores, providing insights into consumer spending trends. Strong retail sales suggest robust consumer spending and economic strength, potentially leading to higher stock prices. On the other hand, weak retail sales may indicate weaker consumer demand and economic slowdown, potentially leading to lower stock prices and increased bond prices.
Manufacturing and services data. The Purchasing Managers Index, or PMI, includes both manufacturing PMI and services PMI. These indexes gauge the health of the manufacturing and service sectors, respectively, based on surveys of purchasing managers. Strong PMI readings indicate expansion in the respective sector and economic growth, potentially leading to higher stock prices. Conversely, weak PMI readings suggest contraction in the sector, which could lead to lower stock prices and changes in bond yields.
Housing data is a crucial indicator of economic health. Existing home sales measure the number of previously constructed homes that were sold in a given period. New home sales, on the other hand, track the sales of newly constructed homes. Now, let's talk about the impact on markets. Strong housing data often signals economic strength and can lead to higher stock prices and changes in interest rate expectations. Conversely, weak housing data may indicate economic weakness and lead to lower stock prices and bond market fluctuations. So, as you can see, housing data plays a significant role in shaping market expectations and economic outlooks.
Trade balance. The trade balance is the difference between the value of a country's exports and imports. When we talk about its impact on markets, a trade surplus indicates that a country exports more than it imports, which can be positive for the currency and stock market. On the other hand, a trade deficit suggests that a country imports more than it exports, potentially weakening the currency and impacting stock prices negatively.
Consumer Confidence Index, or CCI. This index measures consumer sentiment about the economy's current and future conditions. Now, its impact on markets is quite significant. High consumer confidence generally leads to increased consumer spending and can boost stock prices. Conversely, Low consumer confidence may signal reduced consumer spending and potential economic slowdown, leading to lower stock prices.
Central bank minutes and speeches. These are minutes from central bank meetings and speeches by central bank officials, providing insights into future monetary policy actions. When we see hawkish statements, it indicates that the central bank may raise interest rates or tighten policy, which can affect stock and bond markets. On the flip side, dovish statements suggest that the central bank may lower rates or adopt a more accommodative policy stance, which can influence markets positively.
Understanding these economic indicators helps traders make informed decisions by providing insights into the health of the economy, potential changes in monetary policy, and overall market conditions. By analyzing these data points, traders can better anticipate market movements and adjust their strategies accordingly.